Okay, welcome to Accounting 101, where we are going to be going over the solutions to the assignments for Chapter 5. So please bear with me here. I have 2 sheets of paper, my clipboard, and 2 computers up. Review questions 3, 4, 5, 6, 10, and 21. Maybe we'll throw a couple extras in. Let's see. Describe the operating cycle of a merchandiser. Well, the cycle begins when the merchandiser purchases inventory from a supplier, usually called a vendor, could be a manufacturer, distributor, what have you. And then they turn around and sell that merchandise inventory to customers. And then collecting the cash from the customers and then starting the cycle all over again. So, you start, got something here. Okay, had something on the screen popped up. I'm sorry for the interruption. Here's your business. You buy inventory, you have more assets, but you also have more liabilities. You sell the assets, get, for a profit or hopefully for more than you paid for it, growing the business, using some of that cash to pay off the inventory you bought, if you bought it on credit, and then again, turning around and buying more inventory, and constantly trying to grow the business, increase sales more and more within reason, and keeping track of how much you owe the vendors and how much your customers owe you. And hopefully you can collect from your customers in time to pay your vendors off. Cash flow is very important. Review question number 4. What is the cost of goods sold and where is it reported? The cost of goods sold is the cost of merchandise that has been sold to customers out from merchandise inventory. Okay. Like all assets, merchandise inventory helps us generate revenue. Perhaps it is the most closely linked with generating revenues from selling the product, reselling the product to customers. It is shown on the income statement in one of 2 ways. Well, it's an expense. It can be a line item on the income statement, or it can be embedded, the computation. It could be embedded on the face of the income statement. Another option would be to show it as a line item and have a schedule in the notes to the financial statements showing the computation. Okay. Review question 5. How is gross profit calculated and what does it represent? Gross profit is net sales revenue less the cost of goods sold. Okay, it represents the markup on the inventory, the gross profit that you have to cover your other operating expenses other than the cost of the inventory you sold. Okay. Review question 6. What are the 2 types of inventory accounting systems? Briefly describe each. Okay. 2 types of inventory system are the periodic inventory system and the perpetual inventory system. The periodic inventory system requires businesses to obtain a physical count of the inventory to determine the quantity on hand. It is normally used for relatively inexpensive goods that have a high volume of turnover, high sales volume. The perpetual inventory system keeps a running total in real time of merchandise inventory. That is, each change in inventory, additions to inventory when you buy product from vendors, and reductions to inventory when you sell the inventory to customers. It keeps track of merchandise inventory by not only in terms of dollars, but in terms of units, the number of units you have. Okay. Let's look at, it wasn't assigned, but number 11, FOB. Let's do 9 also. What are the what is what would the credit terms quote 2/10 comma n/EOM mean? Well, that would be that you have a 2% discount if you pay within 10 days of the date of the invoice, and otherwise you have to pay the full amount of the invoice by the end of the month. Okay. 10. What is a purchase return? How does a purchase allowance differ from a purchase return? A purchase return is when the inventory items are actually sent back to the vendor who you got them from. Okay, so you'd have to reduce merchandise inventory and either get a refund of cash if you pay cash, or reduce your accounts payable if you purchase them on credit on account. Okay. You would return merchandise if it was in excess of what you ordered or not up to specs, okay, or if it was damaged in transit, or if you made an error in ordering it, ordered too much. A purchase allowance, on the other hand, is a reduction in the cost that the vendor offers you as an incentive to keep the product. If it's the wrong color, wrong size, wrong specifications than what you ordered, or it is scratched or dented, to save the expense of shipping it back and restocking it and maybe fixing it up, the vendor will knock down the price to get you to keep the items. So it effectively lowers the cost that you paid for the item that is damaged or not up to specifications of what you ordered. Okay. The returns and allowances both decrease the amount you have invested dollar-wise in inventory. Returns actually reduce the amount, the units you have, where the purchase allowances do not reduce the units, just the cost. 11. FOB, describe FOB shipping point and FOB destination. Again, that determines, the book says it determines who pays the freight. More importantly, it determines who owns the goods. So if something happens in transit to the inventory, depends on who owns it, files the insurance claim or recognizes the loss if it's not insured. FOB shipping point means the buyer takes ownership to the goods after the goods leave the seller's place of business, the shipping point. In this case, the buyer, owner of the goods, while in transit, also pays the freight. They have the risk of loss while in transit. FOB destination means the buyer takes ownership to the goods at the delivery point when they arrive at his designated place of business. In this case, the seller, owner of the goods while in transit, usually pays the freight. Usually. Okay. 13. What are the two journal entries involved in recording the sale of good inventory using the perpetual inventory system? Well, you have to journal entry to when you use the perpetual system to record the sale. So you're either going to debit cash or accounts receivable if it's on account, or maybe both, and credit sales or revenue account. And then you have to do another entry to record the fact that merchandise inventory account has been decreased. It's an asset, so it will be credited with the offsetting debit going to cost of goods sold. Describe the multi-step income statement, number 21. Multi-step income statement has several parts to it. Okay, up the top, it has net profit, which is sales less the cost of goods sold. Underneath that, you have a section called operating expenses, and they're broken down into two categories: selling expenses and administrative expenses, sometimes referred to as general expenses. Sometimes you'll see it as G&A, general and administrative expenses. And then you subtract those expenses from the gross profit, and you will get what we call operating income. That's a very important number. A lot of people say bottom line is what matters. Yes, the bottom line does matter, but there's uh, a lot of importance placed on income from operations because that's what the business does 24/7, 365 days a year. That's the integral part of their business. Okay, you may have other things from subletting some of your floor space to a concessionaire. Might have some interest, rental income. You might have income from selling a fixed asset. Those are ancillary to your bread and butter business. Okay, after the operating income, you have a thing called other gains and losses or other expenses and income, minor things. And that will give you income before income taxes. Then you have income tax subtracted from that, and that will produce your net income. So you can see it has a lot more steps. That's why they call it multi-step than the single step income statement. Okay. Both of them will report the same uh, net income. The only thing is the multi-step income statement, which is used by uh, merchandising concerns, has a lot more detail in it. Okay. All right. Short exercise 1, 2, 3, and 4. Let me get the electronic textbook pages turned, hopefully. Um, Short exercise 1. Comparing periodic and perpetual inventory system. For each statement below, identify whether the statement applies to the periodic inventory system, the perpetual inventory system, or both. A, normally used for relatively inexpensive goods. That would be the periodic system. You could use a perpetual system, but you'd end up pulling your hair out when you have to take off things that are priced at a nickel or cost you 3 or 4 cents, and you have a couple thousand of them going out the door every day. B, keeps a running total, well, it says keeps a running computerized record of merchandise inventory. It doesn't have to be computerized, it could be manual. Of course, every day, everybody's got everything on computers and their phones anymore, but it could be a manual system. That would be the perpetual system, keeps a running total. Every change in inventory is recorded in the merchandise inventory account as it happens. C, achieves better control over merchandise inventory. Well, that's clearly the perpetual inventory system because at any given point in time, you know what you have or you know what you should have. Again, there are things, shortages, spoilage occurs, shoplifting, whatnot. Uh, D, requires a physical count of inventory to determine the quantities on hand. Well, that would be, you would think the periodic, but actually, you should actually do it with both systems. It's a requirement that even if you're using the perpetual inventory system, that you do an inventory at least once a year to reconcile what you actually have on hand and what the accounting record, an account merchandise inventory tells you have on hand for the previous mentioned items. Spoilage, if you're, food wholesaler, sometimes the produce or meats will be go past the date. You could sell them. Shoplifting, other, theft, other ways things can disappear. Inventory has a habit of sometimes shrinking. So D, the correct answer would be both the perpetual and the periodic system. E, uses barcodes to keep up to the minute records of inventory. That would be the perpetual inventory system. Okay, that brings us to short exercise 2. Come on. Oh, jeez. All right, what do we got here? Journalized purchase transactions. Consider the following transactions for toys and more. They give us 3 dates, 3 things happening. Requirement 1, journalize the purchase transactions. Explanations are not required. Okay, so on May 8th, Toys and More purchased $113,300 worth of Mega Block toys on account with credit terms 210 net 60. Get my calculator set up over here. Okay, so we're purchasing them. So inventory is going to increase. It's an asset account. So we're going to debit merchandise inventory. And it says we have credit terms, so we're not paying cash. It's on account. So we're going to increase the liability accounts payable. And now we're going to have several vendors. So we're going to start keeping track of each particular account payable. Everybody we do business with, that we buy product from, we're going to have an account payable. And so we're going to have accounts payable hyphen the name of the company we're buying the stuff on credit from. And the amount was $113,300. So you pick it up, add its full invoice amount. We will not recognize the discount until we earn it, till we take the discount by paying within 10 days. Let's see what happens next. On May 12th, Toys and More returned $11,250 of the merchandise to Mega Block due to damage during shipment. So now inventory is being shipped back to the vendor we bought it from, Mega Block. Started writing them down, so what we're going to do, just have to make a ugly scratch up. So merchandise inventory is being reduced. It's an asset. It's being sent back to Mega Block. So it's an asset, so to reduce it, we credit merchandise inventory for the amount, $11,250. And if we're sending it back, we're no longer obligated to pay for it, so we reduce the liability accounts payable to Mega Block. We're reducing the liability and we're reducing the asset merchandise inventory. On May 15th, Toys and More pays the amount due less the return and the discount. So they're telling you here that they are in the discount period, but we can see that May 8th is the day of the invoice. So the terms were 210 net 60. So we'd have to May 18th to get the 2% discount. So we are within the discount period. So we only have to pay them 98% of what we owe them. But let's figure that out. Accounts payable, Mega Block. I'm going to draw a little T account here. We originally owed them $113,300 for the order. Accounts payable, Mega Block. We returned $11,250. So our current balance we owe them $113,300 minus $11,250. The balance there is $102.50. $102,050. Okay, but we're paying within the discount period, so let's figure out the discount. Oops, got 2 lines. Times 0.02. That would be $2,041. 2% of the amount we owe them, the net amount we owe them after the return, times 2%, $2,041. I might be neurotic, so I like to check myself. Now I'm going to say 102,250 over here on the left side times 0.98 because it's a 2% discount. 2, 0.50 and that's $100,009. So that's how much we're going to pay them. That's the amount we owe them. But they said, hey, if you pay within 10 days, you can take a 2% discount, which is $20.40. Now all we have to do is the entry to record all that stuff. Let me move this back a little bit. So on May 15th, we have to do a journal entry that will satisfy the accounts payable that we have, and that's at the full gross amount, less the return. Okay. 102,050. Now our accounts payable is showing a balance of 102,050, $2,050. So we have to back that out. We have to credit that account for what it's showing because we're going to pay them. Although we're going to pay them less because we're taking the discount. I threw it all on the wrong side. Yeah, I make mistakes just like everybody else. Now we're going to give them cash payment. How much cash? Well, you can figure it two ways. You can how much we owe them less the $2,040, but you can also say, hey, what we owe them times 98%. That's the amount of the check. This less the discount or that are the same number. Two ways to get there. So we're going to write them a check for $100,009. And as you can see there, I have a journal entry where the debits and the credits do not equal. But what's the difference there? The difference is $2,041, which is the amount of the discount, which is a reduction of what we paid for the merchandise inventory. So we're going to credit merchandise inventory for the amount of the discount. And that way, I'll show you what happens. The T count, there's the entry. Okay, I'm going to do a T account. I wonder if I can get a pen. Yeah, a pen might a little bit. Medium point instead of a fine. I had a fine point. No, that's a fine point T. Let's see if this is better. Yeah, it might be. Merchandise inventory. Okay, so I just made a little merchandise inventory T account. It's an asset. What happened? Well, when we bought it, we got $113,300 debit into that account. That's the initial order being delivered on May 8th. And then we reduce it for the goods that were damaged in shipment on May 12th. Here's the initial order, full order, the amount that was damaged in shipment we send back. And then we also take a discount because we paid payment within the discount period. No units are changing hands, just a dollar value on May 15th. So there's the full order coming in. There's the damaged goods being shipped back. There's the discount being used to reduce the amount of inventory. Now let's see what the total is. And it should be $100,009. So 113,300 less 11,250 less 2041. And that is a balance of $100,009. $100,009 and oh, I didn't write the entry. Oh, yeah, I did down here. I screwed up. Okay, there's the cash, $100,009, and that's what we have in the merchandise inventory account. Counting is beautiful. Let's see, I just locked up the computer over here, so I got to. Okay. All right. In the final analysis, how much did the inventory cost toys and more? Well, in the final analysis, everything after the return and after the discount, $100,000, $100,009. Okay. Okay. Short exercise number 2. Journalizing entries. Consider the following transactions. That was 2. Number 3. I'm sorry. I'll be all right someday. Journalizing purchase transactions. Consider the following transactions for Burlington Drug. Okay, on February 2nd, Burlington purchased $23,800 worth of inventory on account with credit terms 215 net 30, FOB shipping point from Green Medical Supplies. Okay, so they're taking ownership at the shipping point. So they're going to have to pay the freight. So February 2nd, we're going to do an entry to record merchandise inventory being increased with the debit, and accounts payable. And once again, we know who it is. They're identifying it, so we're going to have an account payable for Green Medical Supplies. The full amount, $23,800. Okay, so there's the entry. The asset merchandise inventory is being increased with the debit. The liability accounts payable to Green Medical Supplies is being increased with a credit. On the 4th of February, we pay a $50 freight charge. That is going to increase the cost of the merchandise inventory account. So that will get a debit of $50, and we will give the trucking firm a check for $50. February 9th, Burlington returned $5,200 of merchandise due to damage during shipment. So the merchandise inventory account is going to be reduced because we're shipping it back to the vendor. So we're going to credit merchandise inventory for $5,200. And we're going to reduce the liability to Green Medical Supplies for $5,200. Because we return the inventory, we don't have to pay for it. Okay, third entry. Accounts payable to Green Medical Supplies reduced $5,200 with the debit. Inventory, merchandise inventory sent back has to be reduced with a credit, $5,200. And then finally, on the 14th of February, we pay Green Medical. We pay the amount due less the return and the discount. Well, let's do a little T account and see where we stand with Green Medical Supply. Accounts payable, Green Medical Supply, I'm just going to call it Green MS. We originally owed them $23,800. initially. Then we sent back $5,200 because it was damaged. So we reduced the liability with a debit of $5,200. So now we figure out how much we owe them. What's the balance there? 23,800 less 5,200. $18,600 is the balance. $18,000 credit balance. I made a mistake. It's not going good for me today. $18,600 we owe Green Medical Supply. But let's see here. Freight term or the credit terms were 2/10/15. So February 2nd plus 15 would be February 17th. We're paying on the 14th, so we're within the discount period. So we can take 2% as a discount. $102, $372. And then I like to figure out, check myself with how much we're going to write the check for by taking 1 minus the discount, which is 2% here. So I'm going to go 18,600 times 0.98. And it looks like they'll be satisfied with the check of 18,228. Discount payment. Okay, so I just took the amount we owe them, 18,600, and I took the 2% to figure out the discount, which comes out to $372. On this side, because I can have a bad day, as you can see, I am, and I'd just like to do a self-check. Take the amount we owe them, $18,600 times 0.98, which is 1 minus the 2% discount. And that's the amount of the payment we're going to send them, $18,228. And the $18,000, the gross amount, $18,600 less the $372 should equal the $18,228. Let's see if it does fall out in the wash. So on the 14th, we are going to satisfy our liability to Green Medical Supply. So we're going to debit accounts payable, Green Medical Supply. And that is going to be at the total amount of $18,600 because that's what's in that account. That's what's in the account, and that's what we're satisfied. Although they told us, they authorized, saying, you pay us within 15 days, you can take a 2% discount. So we'll pay them cash of $18,228, which we computed down here. Cash $18,228 satisfies that because that is 98% of that. So we're taking the 2% discount. The balancing figure for that entry would be a $372 credit, and that's the discount, which is effectively going to reduce the amount the inventory actually ended up costing us. So merchandise inventory and asset gets reduced by the discount. Okay. Requirement, generalized purchase transaction. We did that in the final analysis. How much did the inventory cost Burlington Drugstore? The $18,228, because that's what we wrote the check for when all is said and done. We have to take into consideration the return and the discount. Okay, now moving on to short exercise 4. 1, 2, 3, 4. Oops, went too far. Wait, did I screw up there? My math? Now let me check my math on that last one with Green and Burlington. Like I said, not having a good day today. 2,228 plus 372, 18,600. Oh, okay. Yeah, I forgot about the freight charge. So, yeah, the 18,228 we paid Green plus the $50 freight charge would come out to $18,278 is what what's the name of that drugstore? Burlington Drugstore would have paid Green Medical Supply $18,228 for the drugs, plus the $50 it cost them to have them shipped in. So the $18,228 plus the $50 freight charge would make the total cost of the drugs to Burlington $18,278. You want to do, you could do a little T account, and you would see that well, let's do that. Merchandise inventory. We originally got 23,800. We shipped back plus $50 for the freight, and then we returned 5,200, and then we had a discount of 372. Right? Return, discount, freight, cost of drugs. All right, so we have the cost of the drugs, we have the freight to get them where we need them, we have the return, we have the discount. Let's see what that adds up to. 23,500 plus 50 less 5,200 less 372. That's not right. 23,800 plus 50 plus 18,278. There's the balance, and that's what we wrote the check for. Well, actually wrote two checks: $50 for freight and 18,000. Oh boy, I'm glad that one's done. I didn't do too good there. Forgive me. What do we got here? 4, generalizing sales transactions. Okay. The first couple we did were purchasing merchandise inventory. Now we're going to be selling the merchandise inventory to our customers. Okay. I guess I should put short exercise 5-4 up here. I didn't do it on the other ones. Sorry. Generalize the following sales transactions for Thomas Sportswear. Explanations are not required. The company estimates sales returns at the end of each month. Okay, July 1, Thomas sold $21,000 of men's sportswear for cash. Cost of goods sold is $10,000. The reason I'm telling us that is in all these exercises, we assume they're using a perpetual inventory system as opposed to periodic. So whenever we have a sale, we have to do 2 entries. one to record the sale, one to record the change in inventory. So let's see what happens on July 1 here. We sold it for cash, $21,000. So cash is increasing, 21,000. And sales revenue, or just sales would be okay too. So that's what we're doing with our customer. They're giving us cash. They're taking the men's sportswear for $21,000. Now, that inventory cost us $10,000. So we have to reduce the inventory, merchandise inventory, by $10,000 and increase the cost of goods sold by the same amount, $10,000. Okay, on the 5th, Tomas received a $6,000 sales return on damaged goods from the customer on July 1. Cost of damaged goods is $3,000. Okay, so July 5th. What do we got here? Refunds payable. $6,000. Cash. And then recorded the fact that the merchandise came back. And credit estimated returns inventory. Okay, that brings us over to exercises 20, 22, and 35. Even though 35 is listed under a problem, there is no problem 5-35, as I alerted you to the fact with the email of Thursday, February 23rd. So I gotta get down to 20. Whoops, too far. I love this electronic textbook. Exercises 20. For all exercises, assume the perpetual inventory system is used unless stated otherwise. Round all numbers to the nearest whole dollar unless stated otherwise. Exercise 20, 5-20, using the accounting vocabulary. Match the accounting terms with the corresponding definitions. So the first one they give us there is credit terms. So that looks like H, item H, the terms of purchase or sale as stated on the invoice. Again, credit terms can be when we're buying stuff or when we're selling stuff. 2, FOB destination, freight on board destination. So that means title changes at when it arrives at the purchaser's thing, so the seller retains ownership. D, a situation in which the buyer takes ownership at the delivery destination point when they arrive at their place of business, at the purchaser's place of business. So while it's in transit, it is owned by the selling company. 3, invoice. last one down, the seller's request for cash from the purchaser. It also has, the one in the book showed you, what was it, 8, 9, 10 different important pieces of information in there. The seller's name, the buyer's name, delivery to, credit terms, description of the product. But yeah, it's basically a request for payment for the goods listed on the invoice. 4, cost of goods sold. A, the cost of merchandise inventory that the business has sold to customers. 5, purchase allowance. B, an amount granted to the purchaser as an incentive to keep goods that are not as ordered. 6, FOB shipping point. Towards the bottom there. G, a situation in which the buyer takes title to the goods after the goods leave the seller's place of business. So I'll recap these when we're done. 7, wholesaler. E, a type of merchandiser that buys goods from manufacturers and then sells them to retailers. 8, purchase discount. F, a discount that businesses offer to purchasers as an incentive for early payment or quick payment. 9, retailer. C, a type of merchandiser that buys merchandise either from a manufacturer or a wholesaler and sells those goods to consumers. So recapping these, 1 would be H as in Howard, 2 would be D as in David, 3 would be I as in ignorance, 4 would be A as in apple, 5 would be B as in Bob, 6 would be G as in good, 7 would be E as in elsewhere, 8 would be F as in funny or Frank, and 9 would be C as in Charles. Okay. Exercise 22. All right. Journalizing purchase transactions. Okay, not so. Okay. Howie Jewelers had the following purchase transactions. Journalize all necessary transactions. Explanations are not required. Okay. So we'll start it up here with June 20th. And dial a line down for my debit and credits. And not the same size, so it's going to look ugly. June 20th, we purchased inventory of $5,100 on account from Sanders Diamonds, a jewelry importer. Terms were $215 net 45 FOB shipping point. Okay, so we're getting merchandise inventory. So we're going to debit the asset account called merchandise inventory for $5,100. And it's on credit because we have credit terms. So we're going to increase our liability accounts payable, and we're going to keep track of who it is, because here I think we have several vendors. Accounts payable with Sanders Diamonds. Okay, $5,100. On June 20th, we pay the freight charges because it was FOB shipping point. So the cost of shipping is going to increase the cost of the asset, merchandise inventory. So we're going to debit merchandise inventory for $400.